Investor readiness. What does it mean now? We'll talk about that on Builders Live. Hey, I'm Chris Wink. I'm the co-founder and CEO of Technically, the news organization with a community of technologists and entrepreneurs. Investor readiness is this phrase we've used for a good long while to describe how an entrepreneur is prepared to pitch typically venture capitalists, the other kinds of financing we sometimes talk to. It comes with a whole boatload of baggage, and a lot of it has shifted in the last few years. What I remember to be investor readiness a decade or so ago seems to have shifted. So we're going to check in on what do we mean by the term investor readiness. And to do that, I'm joined by Anthony Millin. He's the founder and co-chair of NEXT, powered by Shulman Rogers, a platform I know well, based inside of another firm. So he's entrepreneurial, and I've known him a while. Anthony, thank you for being here.
It's great to be here with you today, Chris.
All right, Anthony, maybe even a little bit by way of background, start me with some basics, because you and I both know that this term has grown and shifted some over time. When you say investor ready for an entrepreneur, what do you mean? And I assume it means more than just a pitch deck.
Yes, so I'm going to talk about it today from a few different perspectives. I have been in the startup ecosystem now for 25 years. I've spent time as a serial entrepreneur, co-founding companies, time as a venture partner in a seed stage VC fund. Right. And as you mentioned, most recently as the founder and co-chair of NEXT, which is a whole new model focused on delivering legal services to startup and early stage companies. So I've been through the process from all of these different perspectives. I think one of the most important things when you're looking at being investor ready, what you're really talking about is being ready for this process of going out and raising capital. And there are a number of things that you can do to really help prepare for it. And why it's so important is if you're out raising money, you do so much work trying to get those meetings, trying to get in front of investors. Mm-hmm. And you can spend so much time that you want to maximize the opportunity when you eventually catch the bus, when you're eventually in front of investors and you're ready for that. So the first thing is being investor ready is understanding where you are and in the stage of the company that you're in is one thing, and to make sure that you're aligned with the types of investors that you're talking to. So if you're a pre-seed company or you're a seed stage company, you're aligned in stage with the investor. You also want to be aligned with the investors in terms of where they focus. So if you're a company in medical devices, you want to be dealing with investors who are focused on health and life sciences and maybe even more specifically medical devices. So the first step is pick the right investors to be in the room with. And that's part of being ready, doing your due diligence and your research and your work to get in front. The next thing you want to do is you want to make sure all your foundational legal documents, all your whole legal foundation is solid. And so you want to not start that process until you know your formation documents and the way you've given equity to the founders and whether vesting is part of the structure for the founder shares and whether you've protected your intellectual property. There is a range of legal documents and legal efforts that are foundational that you want to make sure is in place. It's something you can control before you start the process. You also want to make sure that the moment the investors tell you they're ready to start due diligence, you're not scrambling to get all those documents organized and starting the process of setting up your legal data room. You can start that process of setting up your legal data room on day one of forming the company and keep it organized. But you certainly want to make sure that the way the data room is set up is the way an investor is going to want to go through it. It follows the logic of a due diligence checklist. All your documents are in the right folders and are correct. From a financial point of view, you want to have a financial pro forma financial model in place. And there, what's really important is being ready to explain and show investors that you understand all of the assumptions that drive the business model that you're looking to build. So you want to spend time on that. And then you also need to know what you're asking for. So you need to know, how much are you looking to raise? Are you looking to raise 500,000 or 2 million? And why? What are your use of proceeds? Those are questions that are going to come up that you want to have spent time really understanding what your expenditures are going to be over the next 12 to 18 months. You want to raise enough money to have enough runway, which depending on your stage of your business could be 12 to 24 months. So that you have asked for enough money and that the logic of your use of proceeds and what you're trying to build matches that. So this is all work that gets done before you even start the process. And then you want to make sure you have a really seasoned startup attorney who is by your side as you're ready to start the process, who works with startups, who understands market terms, who can explain to you what to expect at each step of this journey of being ready for the investor. It can really help you get there.
Lot of questions to get in there, but maybe let me take a half step back, something that I know you also know. People get tripped up about what is an investable business. One, that word investment obviously means lots of things. There can be times where, for strategic or partnership or familial reasons, someone can put money in that is different than kind of a traditional fund. So we know that the vast majority of businesses do not make sense for venture capital style outside financing. Maybe give me that gut check, Anthony. One, why do we talk so much about VC in the culture if it reflects such a small sliver of the companies out there? And when you say investor ready, is that really code for venture capital, that particular slice of a particular slice of a particular slice of business investing?
So when you capitalize a company, there are many different ways to capitalize a business, and different businesses require different amounts of capital at different stages and different periods of its growth journey. So talk about VCs. VCs are just one element of investing. And in that same category, you've mentioned friends and family or angel investors or crowdfunding. So there is investment that involves giving up some equity in your business, but even within that bucket, it can be a range of types of investors. And for that, some of the things that I talked about before in investor readiness are really important. But there are other things that will be important as well, even if you're bringing money in from or working with different groups. So you could be working with a strategic partner who's helping you and excited about the business you're building that may have some equity component to it. And different parts of investor readiness will be relevant for that conversation. You may early on decide to join an accelerator, even before you bringing in VC type funding, and elements of that investor readiness are going to be important for that process. You may be applying for a grant, non-dilutive capital, and some of the components of having your legal structure solid and your financials in order those will be important to that as well. Some businesses are able to generate revenue fairly quickly. They're not spending huge amounts of capital, losing money to gain market share rapidly, and then going out for another big round of funding to continue that cycle. Some businesses are focused on, how do I get to break even and profitability as on a faster scale and a different type of growth curve. I'm not going to try to build as big a business as quickly, but I'm going to take a different level of risk, but I will still need capital. And maybe if you're able to get to a point of profitability, break even, and then profitability, banks become an option and credit lines become an option. But they're going to review legal documents and they're going to review financials, and they some of those same elements of what we spoke about are going to be important. And then if you're generating revenue, there's other types of capital that can come in as well, like revenue-based financing that does not involve necessarily giving up equity, or maybe it's just warrants, but there people are valuing the fact that you are generating revenue and the financing is tied to revenue, again, being investor ready for that category, a class of investors, different to VC investing. And finally, factoring receivables and customer financing are options as well, where some of this becomes important. So it's really important to remember that you want to look at the kind of business you're building, and you want to look at all of the range of options for capitalizing the business and understand how much you really need, how much risk you want to put on the business, and the pace you're looking to grow as it correlates with that risk.
That's well said. And I think in my reporting career shows up why so many people can talk past each other on this conversation, because we can be talking about different kinds of business or different contexts. I have a friend who always likes to say there's a kind of investment that is just the fast forward button. And there are lots of businesses that you don't want to hit the fast forward button yet because you're still figuring stuff out and it's a bad time to hit fast forward. But there are other times where like you're hitting the fast forward button because you have a particular bet about a particular moment and you're trying to go as fast as you can to test out that bet. And that's then when the fast forward button makes sense. So, all right, how about push me forward to another framework, something that I think there were lots of books in the 2010s that you could buy and would have you a nice little chart and say, this is about the amount of money that happens at a seed stage. This is about the amount of money that happens at a pre-seed stage, Series A. We started talking about all these rules of thumb. A lot has changed. Talk me through those stages, Anthony, and what you're seeing now with either clients or in the markets around the expectations at maybe pre-seed, seed, and let's go as far as Series A, and like rough gauges of even how much money we're talking about. I know that there's a lot of variety, like, devices or hardware companies, very different than
Sure.
a kind of classic SaaS. So I know these are imperfect, but help me a little bit get some sense of range.
So when you look at the stage of the company, pre-seed, seed, and Series A, the first thing you're looking at is where are you in the de-risking process, right? As you're growing a business, on day one, you have capital risk, you have execution risk, you have product risk, you have technology risk. So different as you're growing the business and going through these different stages, you're de-risking the company across those different elements. So the first thing, and what I look at when I look at pre-seed, is you're still like in the concept idea phase of the business, right? And what your goal is and what you're trying to prove is that there is a problem that you've identified and there is a solution that potentially could solve that problem. So you're validating your idea or your concept, right? When you and it may even be at that point, it's often even pre-minimum viable product. You're really just doing a lot of customer discovery, problem identification, solution identification. When you go to seed stage, at that point, you have a minimum viable product. And and we'll talk about what you're doing with the money in the pre-seed stage, but it's to get to that point. Now, what you're trying to do is you're trying to show product market fit, right? You're trying to take that minimum viable product or early stage product, and you're trying to see that it's not only is it a problem and a solution, but it's something that the market sees as valuable, that there are customers who will use it, there are customers who will pay for it. The business model is there for at the point that customers will use it or pay it. So that's kind of what you're trying to validate. That's the goal of what you're trying to achieve in that phase. Then you go to Series A, and now you've kind of already, you got through pre-seed, you found product market fit, you've got some customers that are using it. Now your goal is to grow, right? So now you're starting to raise bigger rounds of money to grow the business, and you're trying to understand the economics of the business and how to drive some costs down. And so that is your goal in that stage. Also, each of those different stages come with different types of investors. So pre-seeds can often just be founders who are funding it themselves. Or that's when you mentioned earlier, friends and family. You're going to friends and family. Some people may go into an accelerator during the stage. And then there are sometimes angels who, they're angels or some pre-seed funds that will fund this stage of it. When you get into seed stage, you're talking more angels, which could be individuals or institutional angels. And then there's seed-based VC funds. They're VC funds who like to come in at this stage. And then, of course, once you get to Series A, you're in your institutional VCs, your corporate VCs. A lot of corporations now have VC funds. And, within those VCs, there are funds that specialize or hone in or like to be in that Series A space, that initial growth space.
Keep going. Sorry.
No. And then the last thing I'll just say is the amounts that you raise and the types of legal securities that you use also vary between these different stages. So kind of understanding what you're trying to achieve in that stage, who are the types of people you'll go after, and then the types of legal securities that fit those stages, and have somebody who can work with you to kind of understand that and understand what the size of the rounds may be at those different points.
A couple of things in there. One, this is not especially novel, and this would be familiar from years back, but when I was hearing you walk through that, I kind of like jotted down here that that pre-seed, the idea stage, it's proven out that there even is a problem, and then at the seed stage, you're showing that you have a solution for that problem, where you get the early customers. Then at Series A, you're proving that you can grow that solution, that it can reach a kind of scale, which is oversimplified, of course, and I'll get yelled at, I'm sure, somewhere. But as a rough schematic, that's what I heard from you, and it hits for me. Talk to me about how the mindset is different for the founder who is aiming to be investor ready. And I think usually when we say the phrase investor ready, we're typically coding that for folks who are doing it for the first time or who are at the earliest stages, but maybe just for the mechanisms of it. How does the mindset change across those stages?
I think the big difference there, we talked about at the beginning, we talked about some of the elements of investor readiness. I think the big things at this stage are, from an investor readiness point of view, are the de-risking that's already occurred and the milestones you've checked off. So for instance, going into a Series A round, having revenue like at least $1 million or more in ARR, or having at least some revenue now in a seed financing round. Like, everything has been moving to the right. What used to get you to a Series B round now gets you to a Series A round. And what used to get you to a Series A round, people want to see for a Series seed. So everything is kind of shifted. where you have to have de-risked or accomplished more than you used to have accomplished for that stage. And we're also at a phase where in the investment market, we'd gone through a period where there was not a lot of liquidity, where investors had placed a lot of bets with companies that are kind of just haven't exited yet. And so investors have found it harder, since they haven't been distributing to their LPs. Many funds have found it harder to raise their follow-on capital, particularly for some of the later stage types of rounds. And so people have become more conservative. They, in terms of how much risk they're taking on. We're still seeing a lot of activity in some of the earlier rounds where people are kind of betting on a portfolio of companies, but it's becoming harder in terms of what you have to have accomplished to get some of that follow-on funding.
I'm going to lose you in a second. That's just a great point. I want to call out, that especially in the cheap money era of the 2010s, there became this kind of cliche of, for a select few in a select place with a select background, getting money is very easy and it's hard for everyone else. And of course, there's some degree of truth to that. But I guess I just wonder if you could touch on how different an experience do you view capital access by who you are, where you are, and what you're doing? Meaning, like, how much do you see that if you have a credible tie to some AI deployment, is that right now genuinely a different time, a different kind of, is it differently accessible than if you're raising another kind of company, a certain kind of era? Talk to me a little bit about how different the experience is depending on who you are, where you are, what you're doing.
Different types of companies, depending on the company you're building, definitely have different levels of access to capital. So, there are people taking very big bets and very big swings in markets that there'll be a small number of winners, but those winners will be multi-billion-dollar businesses. So there's, you read in the paper, and that's what grabs the headlines is, and it looks like everyone's raising hundreds of millions of dollars in funding, but that's kind of just one microcosm of the whole market. And then depending on other areas that you're in, you have to approach it a little bit differently. You may be, like we said, starting with smaller raises and looking at a business model that gets you to break even or profitability sooner. Yep. And grow your business at a different trajectory, because the ability to access round after round after round of capital in larger amounts just isn't necessarily going to be available. And so I do think understanding where you are, if this is your third venture versus your third venture after 2 exits versus your first startup company, has a difference. So, how much execution risk the investors perceive, your network in terms of getting in front of numbers of investments becomes important, because often it's in numbers, just having enough meetings to get in front of the right people. So absolutely. And understanding that and building a strategy around that becomes really important.
I'm going to lose just maybe like last question here. Another way that term investor ready, investor preparedness, capital access, a lot of times those phrases are used to talk about accessibility and representation. Who gets access to this information? One thing that has happened over the last 20 years is the explosion of books, blogs, videos, social, a lot of like great information. And I often find a lot of it is pretty great to give you kind of like a grounding, a foundation in this. Maybe talk to me a little bit about how over your 25 years, you've seen access change. By no one's account are we all the way there, but is capital readiness more accessible and getting more accessible in your experience, or is it still like only a narrow priesthood knows how to do this sort of thing well?
No, I think that they're compared to 20 years ago and even 10 years ago, and in some instances even less than that, there is a lot more support for the startup ecosystem. There are significantly more resources, both in terms of educational material and webinars. There are a lot of people who really are passionate about startups and founders and entrepreneurs who have experience and are willing to come back and be advisors and mentors to early stage startup companies. In areas that they have experience, there are whole ecosystems with accelerators and entrepreneur support organizations in different communities. I think people realize how important entrepreneurship and startups are to the overall economy and to economic development and growth. And so as a result of that, I think and it's not even just you have to be in New York or Silicon Valley or Boston. So many smaller markets, different sized markets all over the country have focused down on the importance of entrepreneurship and startups and are very actively building ecosystems. And part of that is giving founders and entrepreneurs access to materials and advisors and people and support systems which can help them with investor readiness, which is something that you have much more control over.
Anthony, I can't do it better than that. We're going to go out on that. Joined this week by Anthony Millin, the founder and co-chair of NEXT, powered by Shulman Rogers. Anthony, thank you always for the thoughtful perspective.
Thanks so much for having me, Chris.
Appreciate it. See everyone next time. Bye-bye.
Bye-bye.